Welcome back to Boring Currency, where we track physical metals, paper market stress, and the forces reshaping the global financial system. Imagine this. You step into a shop and are hit by a giant glowing sign screaming clearance sale. Prices slashed, falling fast. Your pulse jumps. You rush inside, wallet ready, eager to grab a bargain. Then reality hits. Every shelf is empty. Nothing left. Not 1 ounce anywhere. That is precisely what is happening in the silver market right now. Algorithms are aggressively cutting the price of something that is no longer there. They are advertising a discount on a phantom. If you are staring at charts and feeling fear as the red candles stretch lower, you are buying into the punchline of a terrible joke. The screen insists silver is collapsing. Dealers tell you their vaults are dry. One of these is false, and I assure you it is not the empty shelf. So stop obsessing over the spot price. It no longer matters. I need your full attention because we are about to dismantle the most ridiculous disconnect modern finance has ever produced. We are witnessing a system attempting to value a void. Drop a comment below telling me what time it is where you are watching from. I want to know who is alert enough to understand that a paper promise is not the same as metal in your palm. Let's get started. Let's scrape the paint off this machine and expose the gears underneath. To grasp why metal is impossible to find while the price is falling, you must understand 2 separate mechanisms grinding against each other. This is not normal supply and demand. This is a collision between an outdated paper framework and a new strategic reality. First, study the rhythm of the damage. The pattern is so repetitive it looks scripted. During Asian and European trading hours, silver climbs. It steadily pushes toward $90. Why? Because that is where real accumulation occurs. That is where industrial buyers and sovereign entities are sourcing actual metal. But the instant New York opens, everything flips. Massive sell orders slam into the futures market. These are not sales designed to achieve the best price. Anyone holding real silver and wanting to sell would do so carefully, slowly, to maximize returns. You would never dump millions of ounces in seconds. That destroys your own price. The only entity that unloads that much paper that fast is not selling metal. It is manipulating price. They are weaponizing the order book to trigger stop losses. They are fishing for liquidity. This creates the New York flush. Prices smash down to 83 or 86. Technical traders panic. Algorithms detect momentum and pile on shorts. But here is where the system fails. In the past, lower prices scared buyers away. Today, they do the opposite. They ring a dinner bell for whales. Every time the paper price drops in New York, physical inventory disappears. This is the liquidity vacuum. The paper market screams silver is worth less, while the physical market responds by removing supply completely. The harder paper prices are pushed down, the faster vaults empty. This contradiction cannot survive. Now we move to the second mechanism, the one that changes everything. We now have clear policy confirmation that the United States government is establishing price floors for critical minerals. Do not skim past this. It is one of the largest structural shifts in decades. Silver has officially been designated a critical mineral. Why does a price floor matter? Think in terms of a strategic reserve. If the government decides domestic mining is essential for defense, energy, and technology, it cannot allow prices to fall below production costs. If paper markets push silver low enough to bankrupt mines, national security is endangered. A price floor becomes a government put option. If prices fall too far, the state steps in as buyer of last resort. This destroys the short thesis. If you are short silver now, you are no longer betting against a miner or retail buyers. You are betting against U.S. strategic necessity. You are betting the government will allow its defense supply chain to collapse. That is a losing wager. And the evidence is already visible. Look at COMEX data this month. February is usually a non-delivery month. It is quiet. Positions roll forward. Paper shuffling, not physical movement. But that is not what happened. In just 4 days, nearly 14.8 million ounces of silver were demanded for delivery. Let that number sink in. 14.8 million ounces, nearly 3 times the open interest at January's end. This is a delivery anomaly. New buyers entered, purchased contracts, and immediately demanded metal. They were not hedging. They were not trading. They wanted bars. That volume in a non-delivery month is statistically insane. It is like a blizzard in the desert. It tells you someone is desperate for physical silver and premiums no longer matter. This leads us to backwardation. In healthy markets, futures prices sit above spot due to storage, insurance, and financing. Holding metal costs money. But now we see the opposite. Spot prices fighting above futures. That is scarcity screaming. It means buyers will pay more today than next month because they fear there may be no metal later. Why pay more now? Because you fear default. Because you suspect naked shorts. Because warehouses may be empty. And dealer behavior confirms this. When someone walks in with $25,000 and says, "I'll take whatever you have," that is not investing. That is panic accumulation. That is a market-sensing failure. Bullion banks are trapped. On one side is a government price floor limiting downside. On the other are whales draining vaults at record speed. They are attempting a controlled demolition but running out of ammunition. And ammunition here means physical bars. You can print infinite dollars. You can print endless paper contracts. You cannot print a 1,000-ounce silver bar. Once bars leave registered vaults, they rarely return. They disappear into private storage, industrial stockpiles, or the East. They exit the game. So when you see price drops, do not interpret them as value loss. Interpret them as instrument failure. The gauge is broken. The tank is empty, but the needle lies. The price on your screen is the value of a promise that is increasingly impossible to keep. This is the separation of map and territory. History teaches us one rule here. When map and territory disagree, trust the territory, trust the empty shelf, trust delivery notices, do not trust pixels. Now zoom out. This is not just money, this is power. Silver is not disappearing, it is migrating. For decades, the West treated silver like casino chips, paper contracts, leasing, shorting, price suppression to support the dollar. The East treated silver as strategic. And today, the East is winning. Look at arbitrage. Shanghai silver trades at a 16 to 19% premium over New York. Buy in London at 26, sell in Shanghai at 31. What do? You drain London and ship everything east. That is exactly what is happening. This is a historic wealth transfer. Western paper markets suppress prices, subsidizing bricks accumulation. We are selling strategic metal at a discount to rivals. But Washington finally noticed. The price floor announcement is a wake-up call. By classifying silver as critical, the U.S. draws a line. This is no longer free market metal. It is national security. History helps. The Hunt brothers in 1980 pushed silver to 50 using leverage. Rules changed. They were crushed. Today is a Hunt brothers event multiplied. But the buyers are nations. You cannot margin call a country. You cannot bankrupt a sovereign buyer paying cash. This is the sovereign squeeze. And this time, the U.S. is defending price, not crushing it. Paper shorts play old games. Strategic longs vacuum supply. One trades numbers. The other captures resources. Eventually, paper runs out. When that happens, price will not drift upward. It will reset. It will gap to Shanghai levels and beyond until mining becomes viable again. Cheap silver is finished. Not by opinion, but by policy in Washington and demand in Beijing. Now we enter the engine room. None of this matters without physics. The government panicked because the math failed. Silver demand is inelastic. Jewelry demand can disappear. Industrial demand cannot. Silver is the most conductive metal, the most reflective, the most efficient. There is no substitute in high-performance electronics. Copper is too weak. Gold is too costly. Industry uses silver because it must. 3 demand pillars are crushing supply. First, green energy. New solar cells require up to 50% more silver. Global installations are exploding. China installs more solar yearly than the U.S. has total. Once silver paste is fired, it is gone. Second, AI and electrification. Data centers, EVs, grids, 5G. EVs use double the silver of gas cars. Scale that globally and demand explodes. This demand ignores price. Third, defense. Modern warfare is electronic. Missiles, jets, satellites rely on silver. The Pentagon cannot risk shortages. This creates a non-economic floor. Supply is broken. Ore grades collapse. Silver is mostly a byproduct. Zinc mines close, silver disappears. New mines take 10 years. Even $200 silver won't fix supply soon. That empty dealer shelf is the warning. Industrial buyers are bypassing retail. They lock long-term contracts. Retail now competes with defense contractors. Paper markets trade illusions. Real metal hits walls. The price floor is government admission that discovery is broken. Physics wins. When charts flash red, remember reality. Silver powers energy, AI, and defense. Utility is absolute. Price is relative. The vacuum is only the first symptom. Next comes the call. No allocation. Then price becomes a ransom note. We now reach the verdict. 3 scenarios loom. Final paper smash, sovereign intervention, or force majeure. Strategy is simple. Ignore spot. Prepare for unobtainium. Size positions for volatility. The era of cheap silver is already over. The market just hasn't confessed yet. Don't wait for headlines. By then, it's gone. Don't trust the map. Trust the territory. And if you want more sharp updates like this on boring currency, subscribe and comment boring currency so I know you're part of the community. This video is for education and discussion only. I'm not your financial advisor. I don't know your personal situation, and nothing here is a buy or sell recommendation. Do your own research and think for yourself. Stay safe.